Hello, everyone. Welcome back to another edition of the Weekend Charts. Charlie Bilello here, and I'm going to walk you through another crazy week in the markets. A lot of interesting charts to share, so stick around to the end. If you're watching this on YouTube, take a moment, hit that subscribe button for more content just like it. And if you're watching this and you're looking for a second look on your portfolio or your financial plan, reach out to us today at creativeplanning.com/Charlie. Fill out this form. You'll get a free wealth path analysis from Creative Planning Advisor. And what will that entail? We get a free portfolio checkup, retirement roadmap, proactive tax strategies, insurance and estate planning review. So reach out today, creativeplanning.com/Charlie. We have over 300 billion in assets under management and advisement, and we're all in all 50 states. So we likely have a location right near you. We're here to help. Reach out today, creativeplanning.com/Charlie. So what are we going to be discussing today? Number one, the biggest volatility crash in history. So remember that VIX spike that we had just a week ago? Well, we've seen a complete reversal and more since then. So we're going to discuss that and what that means for the markets going forward. We have a V-shaped recovery in the S&P 500, just an amazing run from the lows on August 5th. We'll discuss that. Number three, we have to talk about the CPI report trending lower once again and what that means for the Federal Reserve and interest rates. And I'm saying say goodbye to that idea of the emergency rate cut. We discussed that last week, and I said that was a ridiculous thing to be talking about. But now I think you can officially say that's over with. Number five, plunging housing starts. So we've got new data on housing starts, lowest we've seen in quite some time. We'll talk about that and other things going on in the housing market. The Starbucks surge, biggest gain in history. We'll talk about why that transpired this week. The decline of the department store. We'll run through that, and we'll end, as we always do, with something positive, and that's rising real wages. Okay, let's begin with the biggest volatility crash in history. So here's the chart of the VIX. Looking at the last few weeks here, you can see that huge spike that we had on August 5th. It closed at around 38 that day. And over the last 8 trading days, the VIX has declined 61%, which is the biggest 8-day decline in volatility in history. So completely reversing that huge run-up that we saw. It was 138% over this 3 trading day period. We've completely reversed that now, and look at these stats here in terms of biggest 8 trading day declines in the volatility index. You can see nothing comes close. The only thing that comes even remotely close is that period in February 2018 when we had a huge spike in the VIX and then it came back down, but that was at 49% in terms of the decline. Here we are over 60% decline in 8 trading days. So really no historical precedent for this type of move lower this quickly. And if we look at the S&P 500 going forward, most of the time over the next year, it's positive. You can see slightly even above average on average, taking an average of these readings. But what I would say overall is the VIX moving sharply lower is not really a signal of very much. It certainly doesn't seem to be a bearish signal, but I wouldn't say it's an overtly bullish signal as well. I would say it's kind of neutral in terms of the market tends to be positive over a 1-year period anyway, and it seems like a big decline in the VIX doesn't seem to be preempting that at all. So not the same, I would say, as a spike higher in the VIX where you tend to see really abnormal returns, positive returns going forward after periods of panic. But when the VIX calms down after those periods of panic, more often than not, you're still higher over the next year. Of course, nothing is 100%. And we can see here from that 2020 example that the market was actually lower over the next year. But with the exception of that, all of these higher 1 year later. What you'll notice here, I think very interesting to point out, is all of these examples here are in recent history, with the exception of 1991 here, all of them coming in the last 15 years or so. And we're talking about a huge increase in volatility of volatility. So it seems like the VIX spikes faster and it comes down faster than ever before in recent history. And so what's the reason for that? Why do we have these huge changes in the VIX? I think there's a number of reasons we can attribute it to, but number one would have to be the increase in products geared towards short-term trading, so options, zero-date options, a lot of products surrounding volatility itself, and just algorithmic trading in general, I think, is making everything more short-term. Never mind the fact that people are just more short-term focused as well, more reactive to news and different events. So for all of those reasons, and the big proliferation of exchange traded products and options and futures over the past 15 years, I think that's why you're seeing just these huge examples. Markets simply move quicker today than ever before on the downside, but it also seems like on the upside as well. And we're seeing that once again today. So very interesting to see this trend here where we're seeing this time and time again where the market panics over a short period of time and then very quickly that panic is released. And in terms of the markets, what that looks like in terms of the release, well, it's a V-shaped rebound. We've seen this a lot, but what really set it off this time, which was very interesting, was good economic news. And so a couple of weeks ago, we were talking about the rise in jobless claims, the higher unemployment reading that the market really reacted negatively to. And since then, we've gotten two jobless claims reports that have been better than expected, moving lower off of that peak from 2 weeks ago. And that's really calmed people's fears in terms of a recession or an imminent recession, and the market rallied on both of those reports. So very interesting that good news, bad news was bad news a few weeks ago, but good news seems to be good news again in terms of the economy, and at least those recession expectations, I think, have come down with amazing speed over the last 2 weeks. And the S&P 500 has responded here. You can see just an enormous rally in a short period of time, up 8.3% off of the low on August 5th. So that panic low on the morning of August 5th, up 8.3% since then. So not completely erasing the correction, but getting close to it, and just a tremendous rally over a short period of time. And if we look at the number of the big stocks in terms of the enormous 8 that I always look at, you can see here the gains have been just remarkable off of the panic lows on August 5th. 35% for NVIDIA, 19% for Meta. The Nikkei, remember the reason for that real panic Monday morning was the Nikkei crashing. Well, look at the response to Japanese equities here. It's 18% rally off of the lows for the Nikkei. Tesla up 18%, Amazon 17%, Bitcoin 16%, Apple 15%, and on and on and on. The Q's up 12%, S&P 500 up 8%. If we look at Apple, again, very interesting. One of the reasons attributed to that decline Monday morning on August 5th was the fact, and we covered this last week, that Buffett had sold almost half of his Apple's position. You could see the gap down here on that news on Monday morning. Of course, the market was down as well, but you can see rallied significantly from the open to the close that day and has completely filled the gap and then some. So just a tremendous rally. Now it's higher than where it was before that announcement. So closing that Berkshire gap down very fast. And so if we look at sentiment here, this is probably the most fascinating thing I've seen in terms of sentiment in a long time. We're looking at the percentage of bulls in the Investors Intelligence Survey, and it's been a record decline over the past few weeks, almost 20% decline in the percentage of bulls. And we haven't seen that over a 3-week period since October 1987 when the market crashed back then. So just fascinating to see the percentage of bulls come down this much without a real crash in the US market. We didn't even have a 3% down day. It was just short of that on August 5th. And you could see, even with the recovery last week, the percentage of bulls actually still moved lower. So this is actually what we wanted to see. It's actually a very good sign to see sentiment cool off this much with just about a 10% decline in the S&P 500. So it'll be interesting next week. Obviously, it was a huge rally this week, and we'll see if they responded to that by becoming more bullish again. But certainly huge cooling off in terms of sentiment. And that's actually a good thing, because we were talking about just excessive optimism in July here at 64% bulls, one of the highest readings we've seen looking back in history. So let's talk about inflation and talk about The market's response definitely was a positive response to all of the inflation data we've been getting over the past week. And if we look at inflation expectations, I think this is a big one because it really feeds in to where people are accepting of higher prices. And you could see the trend here over the past year trending lower. This is a survey of US consumers, and this is actually the lowest reading we've ever seen, asking where they think inflation is going to be over the next 3 years. So they're saying 2.33% on average over the next 3 years. That's the lowest on record. This survey goes back to 2013. So very interesting to see consumer inflation expectations coming down. We got the producer price index before the CPI reading. That came in better than expected, up 2.25%. The consensus estimate was 2.6%. And then, of course, the big one being the CPI report, definitely better than expected as well. I think the overall expectation for the headline was 3%, came in at 2.9%. That was the lowest headline reading for US CPI since March 2021. And the core reading, which excludes food and energy, 3.2%. That was the lowest we've seen since April 2021. So the trend here you can see clearly in terms of core inflation, which tends to be less volatile than headline inflation, lower, lower, lower. 6.6% was the peak back in September 2022. We're at 3.2% today. Still elevated. Of course, the Fed wants to see 2% inflation, but moving in the right direction. And what's the big driver of core inflation and overall inflation as well? That would be the housing number, the shelter component, over a third of overall inflation, even a bigger part of core inflation. And that continues to trend lower, but remains elevated. So we're at 5.1% now, down from a peak of 8.2%. It's been 16 consecutive months where the year-over-year rate of change has come down. But of course, 5.1% still very elevated. And why do we think this is likely to trend lower in the coming months? Because you can see the real-time data here is actually showing rents down 0.8% over the last year. And you can see it's been down year over year for a while. So with a lag, this is likely to continue to trend lower, I would say, in the coming months. And that should lead to a lower core inflation reading as well, likely to get below 3%, I'd say, by the end of this year or early next year. And so if we look at housing inflation, it's been absolutely punishing, above 5% for 28 consecutive months. That's the longest period of elevated housing inflation since the early 1980s. So hopefully this will come down and stay down for a while and allow wages to catch up with those higher prices that we've seen in terms of the housing market. We'll talk about that later. But looking at the breakdown here of different components of CPI, so we peaked in terms of CPI in June 2022, 9.1% increase year over year. Now we're down to 2.9% today. And what's driving that decline is almost everything. So almost everything has a lower rate of inflation today than back in June 2022. You can see huge difference for used cars. They were up 7% year over year in June 2022, now down 11% year over year, actually hitting their lowest levels since 2021 on a nominal basis. Gas prices were up 60% year over year, now down 2%. New cars finally starting to show some price declines as well, down 1% over the last year. So only transportation, which is getting closer here, only transportation is not lower than where it was in June 2022. Transportation up 8.8% back then and still up 8.8% today, but moving lower, moving in the right direction. I think the big component that has been driving transportation costs much higher has been the used car insurance, the car insurance levels in the country continuing to go up. And we really haven't seen this type of move in car insurance rates since the late 1970s. 50% increase over the last 3 years. Just stunning, punishing increase. If you've gotten your car insurance renewal, I just got one recently again, just an enormous increase over the last one just 6 months ago. So they continue to increase prices in terms of insurance rates, 50% over the last 3 years, just an enormous rate. So that's increasing the cost of transportation. So hopefully this really levels out and subsides a little bit biggest increase that we've seen since the late 1970s. Now, I want to make a point on inflation because I always get asked this question when people see that CPI data. You say, okay, it's trending in the right direction, 2.9% higher over the last year. That doesn't mean prices are going down, okay? This is looking at cumulative price increases over the last 4 years, and you can see new cars up 20%, used cars 26%, food at home, so grocery prices up over 21%, food away from home, so you're talking about restaurants, up 25%, transportation costs 38% higher, home prices 48% higher, gas prices 59% higher, and so on. So the cumulative impact of inflation is very much still there. It's just the rate of price increases is slowing down, and that's good news. And why shouldn't we expect a lot of these prices to ever come back down again? Well, I think the simplest explanation is that wages aren't likely to come down, and wages are driving many areas in terms of pricing. It's often the biggest expense for a business. If we take an example of a restaurant and look at wage costs over the past 4 years, much, much higher today than they were back then. And so you're not likely to have prices at restaurants go down when you have that biggest cost for the restaurant going up so much. And looking at, you can see hourly earnings here up 19% over the past 4 years. That's under the rate of overall inflation. So many areas have outpaced that. I'll talk about in the end that we're starting to catch up and move in the opposite direction. So that's good news in terms of wage increases. But unless you think this is going lower, you shouldn't expect overall prices to go lower. What we would want to see, though, is, of course, prices go up less than wages. That's what we've been seeing, and hopefully that will continue. But I think this notion that prices are going to go back to where they were a few years ago, that's simply never going to happen unless you're saying that we're going to have wages go down substantially. And I think no one's going to agree to that. So number 4, say goodbye to the emergency rate cut. So we discussed this last week while the market was panicking. Jeremy Siegel goes on CNBC, says the Fed needs to make an emergency rate cut. This was on Monday morning on August 5th. And he talked about the reasons why. He thinks they should do a 75 basis point cut immediately and then another one in September. But interesting, as the markets rebounded, as volatility came in, Jeremy Siegel very quickly backed off the calls for an emergency rate cut. And he's saying, would it be bad? No. But would it be necessary? No, not at this time. So he no longer thinks that the emergency is necessary. I would agree with that. I never thought it was necessary, regardless of what the stock market was doing that day. But in terms of the market's expectations, big shift. So as the S&P 500 has rallied, every little bit it's increased over the past week. We saw a decreasing chance of a 50 basis point cut and an increasing chance of a 25 basis point cut, which is what the Fed, I think, wants to do and what the market now is expecting it to do. So around 75% probability of a 25 basis point cut, 25% chance of a 50 basis point cut. And if we look around the world at different central banks, major developed central banks that have cut rates this year, so Switzerland, Denmark, Sweden, the Eurozone, the ECB, Bank of Canada, and the Bank of England, all of them cut rates 25 basis points. So the idea that the Fed is going to start out here with 50 basis points, I don't think they want to send that message. Again, if they did an emergency cut, I thought that would have been a terrible message to send to the market in terms of saying, we're in a crisis. We need to cut rates immediately. We can't even wait to that September meeting. And I don't think they want to send that message with a 50 basis point cut to start as well. So I think, assuming there's no serious economic issues or a collapse in the markets over the next few weeks, I think we're going to get that 25 basis point cut in September. And then from there, the Fed will update their projections, and I think they'll signal, oh, do they want to do 25 basis points again in November, or do they want to be more aggressive? But for that first meeting, I really think the odds really favor that 25 basis point rate cut, because I don't think they want to send the message that they need to do something more today, and they need to do more than these other central banks that have already cut rates this year. So if we're looking at the probabilities for November, market's saying Fed will do another 25 basis points at the November meeting, bringing it down to 475 to 5. And then interestingly here for December, markets leading towards a 50 basis point rate cut for that meeting down to 425 to 450. So we'll see. I think by the time we get to that September meeting, the Fed will kind of signal what are they going to do for the remainder of the year, and these odds will change. But overall, markets essentially saying we're going to cut about 100 basis points by the end of this year, and then another 100 basis points in 2025. So a slow, kind of gradual move lower over the next year and a half. Certainly no indication, at least right now, from the markets that the Fed is going to panic and say we need to bring rates down immediately. So there's still a concern, I would say, if you're listening to some of the Fed members about that inflation reading. And I just don't think the economic data has been weak enough where the Fed is going to start off with a 50 basis point rate cut. What will solidify the Fed's decision to cut rates? I think they will get that with the next CPI report. It's going to come out before the next FOMC meeting, and I think you're likely to see a big drop even off of that 2.9% reading. The Cleveland Fed is looking at 2.6% now, so we're likely to see a bigger decline in terms of that CPI coming into the next FOMC meeting, and I think that will be enough. Even though it's not at 2%, I think it will be enough for the Fed to say we're moving in the right direction. We should start cutting interest rates. So let's talk about the housing market. Plunging housing starts. So home builder confidence, we got that report this week, 39. So readings below 50 indicate that builders are more negative than positive. So they're viewing conditions as poor. And what we saw this past reading here for August was the lowest reading for this home builder confidence of the year. So you got to go back to last year to find a lower reading. And this is really translating over now into what they're actually doing in terms of housing starts. We can see here we got this number for July. It was the lowest housing start number that we've seen since May 2020. So during COVID, you can see housing starts plummeted for a month or two and then essentially came right back and ended up surging higher after that. But with the exception of that, you got to go back to 2019 to find levels of housing starts this low, down 16% year over year in terms of these starts. And you can see here the shaded areas are recessions. Tends to happen before recession is you tend to see housing starts move lower. So interesting data point here. It's certainly a leading indicator for the economy, definitely a long leading indicator. You can see peaks up here and takes a while before a recession begins. We peaked a few years ago in terms of housing starts, and now we're substantially lower. So is that following the same pattern? I think this will be another data point to look at in terms of the U.S. economy and perhaps signaling a slowdown to come in the next few quarters. If we're looking at the big reason why the housing market's still in a standstill and why home builders are saying that they're not building a lot, it comes down to affordability. So people simply cannot afford the homes at current prices and current mortgage rates. And we got another reading here from the Atlanta Fed looking at the percentage of your income that you would need to afford the median priced home for sale. And it's at 43.9%, almost a record high. Record high was hit when mortgage rates claimed close to 8%, but still very, very elevated here, well above where we were during the peak of the last housing bubble at 42%. And that's really led to a huge collapse in demand. And even though mortgage rates have come down over the past few weeks as treasury yields have moved lower, we got the 30-year now down to 6.49%. That's not enough. Simply, the rate is still substantially higher than it was a few years ago in terms of the mortgage rate. And you have the fact that home prices not only haven't come down in price, they're still hitting record highs in many areas. And if we look at the percentage of homes that are worth more than $1 million in the U.S. hit another record high during the last quarter, 8.5%. And if you look at pre-COVID, it was below 4%. So 5 years ago, you're talking about below 4% of homes, less than 4% of homes worth over $1 million. Today, 8.5%. If we look at a decade ago, it was less than 2%. So you just have this massive appreciation in home prices. People's incomes haven't kept up with that increase in home prices. And then you throw in the fact that mortgage rates are substantially higher today, and you just have an unaffordable housing market. And here's the breakdown in terms of what it would cost you today versus a few years ago. We're talking about an over 90% increase in the mortgage payment needed to buy that median priced home for sale. Enormous since the beginning of 2020. And you could see shelter CPI just slowly moving higher here. It's up around 25% since the beginning of 2020. But in terms of what it would actually cost someone, if you're looking to buy a home and you haven't bought one yet, you're talking about a much higher inflation rate than what shelter CPI is reflecting. Now, shelter CPI is reflecting the entire market. So if you already bought a home, obviously the increase in home prices are costing you more in terms of insurance and taxes, but not costing you more outright because you locked in that payment. And of course, if you're renting, it's a different story as well. But if we look at new buyers into the market, this is the inflation rate that they're confronting if they choose to go ahead and buy that home and buy it at an unaffordable level. So it will be interesting to watch in the next few months. We're seeing a slow increase in housing supply. I've been talking about that. We'll get more data next week for the housing market, and we'll see if that changes things in terms of the housing market and starts to put a cap, I would say, on prices and slow down the price increases of existing homes. So if we're looking at Home Depot here, I think is a good reflection of the boom in the housing market and then the crash in terms of activity. You can see here Home Depot's net income down now 6 straight quarters. So longest stretch of negative year-over-year growth for net income for Home Depot since 2008, 2009. And you can see just an epic boom in spending at Home Depot in 2020, 2021. So with all of that stimulus money, I'd say the number one area that it went to was people's homes. They were staying at home more often. They did bigger projects. They did a lot of spending in terms of their home. And you could see here the opposite now. And you also have the fact that today there simply isn't a lot of transactions. So you don't have people moving and then upgrading their homes and just new homes, obviously, for sale. New homes being built and being sold has collapsed as well. So all of those reasons, people are spending less in terms of their house than they were a few years ago. And here's just a look at the trailing 12-month income. So normalizing it here, you can see the huge run up from 2019 to the peak here. And then since then, we're down about 14% from the peak in Home Depot. So still overall significantly higher, but well off of the highs from a few years ago. And what will it take for people to start spending money? We need to see increase in activity for the housing market. We probably need to see lower interest rates. If you listen to the quarterly earnings call from Home Depot, they were again talking about fewer people doing big projects and just less activity overall, less in terms of people buying and selling homes and less new homes being built. And that's having an impact on sales and income as well. Okay, let's talk about Starbucks here. Just a record day for Starbucks. And before this record day, Starbucks was having some trouble in terms of the stock price and in terms of the fundamentals. You can see here they reported another year-over-year decline in revenue growth, decline in year-over-year net income. They've been talking about a big slowdown in China in terms of sales, and even the U.S. same-store sales were actually lower than a year ago. And it seemed like the U.S. consumer was pushing back against the higher prices at Starbucks, and they've been doing more promotions and a lot of other things to try to boost that demand. But if we look at this week, we had a gain for Starbucks, 24.5% gain in a single trading day. That is now a new record by far. The previous record came all the way back during the global financial crisis, 18% gain back then. So just trouncing everything else in terms of its biggest share price gains. Starbucks went public in June 1992, so we haven't seen a 20% gain ever in a single trading day. And you can see here what that did to Starbucks's return this year. It went from being down over 20% to being positive on the year due to this enormous advance. It was actually down as much as 24% at its lowest point in May. So why did the stock rally so much? Well, they're attributing it to this announcement of a new CEO who will take over in September. This was the CEO of Chipotle, Brian Niccol. So he's going to move over to Starbucks. Obviously, he had a very good track record at Chipotle. Company did very well. Stock price did incredibly well. What is it costing Starbucks to get him to go to leave Chipotle? It's costing them at a minimum here 85 million. I guess that's what he was standing to make at Chipotle, and he had to leave that on the table. So they paid him 10 million in cash and 75 million in equity just to get him over. And then, of course, he has his salary and incentives going forward as well. So not a small sum of money, and they're expecting him to turn things around for Starbucks. And if we look at the share price gain so far, I'd say that expectation is pretty high here. You had a one-day change of 21 billion in terms of market cap for Starbucks, just stunning in a single trading day due to this announcement. Okay, so we'll see if he can turn things around at Starbucks. Obviously, still Starbucks, a lot of demand from consumers is just slower than it was a year ago, and China seems to be a big issue. So we'll see what levers they can push in terms of starting to improve the company and net income and revenue again. But if you see here, the market cap for Starbucks the last 5 years, kind of flat. We know what the overall market has done. So definitely has been a laggard over the past 5 years. Decline of the department store. This has been a secular trend. This is not surprising to anyone, but just some interesting data points here from the Census Bureau. We're looking at department store sales here, and in the late 1990s, it peaked above 90 billion in terms of sales. And if we look at where it is today, it's about a third at around 30 billion today. And you could just see that enormous, just secular trend lower. Macy's, I guess, being the biggest example of a department store that's still around today. Of course, JCPenney went bankrupt, and others have gone bankrupt as well. Sears, and it's really changing what the mall is starting to look like. You can see Macy's has closed about more than a third of its stores in the last 10 years. It's keeping the ones that are doing the best, getting rid of obviously the ones that are doing the worst. And what are happening to those properties that mainly exist in malls? Well, they're really changing what they look like. They're putting in grocery stores. It was an example of a hockey rink here. Whole Foods, movie theaters, sporting goods stores, healthcare facilities, and of course, Amazon warehouses. Amazon opened a huge fulfillment center on the former site of a Randall Park mall. And you can see the difference in share prices last 10 years, Amazon and Macy's. Amazon up 962%, Macy's down 54%. So a little bit of a disparity there. And obviously, this is a secular trend, people just buying more of their goods at home in terms of shopping. That doesn't mean the mall is dead. It's certainly in a decline, but the mall is changing, and it's really a bifurcation of first class malls are actually doing well, and the bottom tier malls are not doing so well, and they'll have to make those adjustments to bring the consumer back in terms of what's the current demand. And the current demand isn't for these big department stores anymore. So big secular trend that doesn't seem to be over yet. And it'll be interesting to see what these malls look like. It seems to be more centered around food, entertainment, than just pure retail shopping. Okay, I want to end as we always do with something positive. We got to talk about rising real wages, because to me, this is the most important chart in an economy, and it's trending now in the right direction. For a long time, you probably got tired of hearing me talk about it, but I mentioned that for 25 consecutive months, this was in negative territory, in a bad place. Wages were not keeping pace with inflation, but now for 15 consecutive months, wages have been outpacing inflation. So we got that 2.9% inflation reading, and we have wages up 3.6% over the last year, and that's good news. That makes your purchasing power improve, and we want to see this continue in the coming months. And this is why I keep saying this, but I'll say it again. I don't think the Fed should be in any hurry to cut interest rates. Make sure the inflation problem is solved. That is how we got back into positive territory. It wasn't from wages going up, it was bringing down that inflation rate. So the policy of normalizing monetary policy, and that's really all we've done, is normalizing it. We were excessively easy We printed a lot of money. We're still doing the fiscal deficit thing, but better, of course, than it was a few years ago. We need to keep this normal policy in place so that inflation doesn't become a problem again. So we don't want to see this go negative again. That would be the worst thing. Let's keep it going into the future here. Let's keep monetary policy at normal levels going to the future. We don't have to go back to 0% interest rates. I think that was a big mistake, and we shouldn't go back there again. Okay, we'll end it right there. Thanks everyone for joining me on the Weekend Charts. Have an awesome weekend, and hit that subscribe button if you're watching this on YouTube, and I'll see you next time on the Weekend Charts.